What's up, guys? How's everybody doing? Let's get the chat. How's the sound? Sound good? What's going on? What's going on? Good morning, guys. It's 10 o'clock in the morning, 30 minutes after New York Open. So, do a little morning stream. I have to build a big outdoor furniture set today. And I have to go to a doctor's appointment in about an hour and a half. It's up the block, so not up the block, but it's pretty close. So I want to get the stream in. And yeah, about to go to bed. So everyone can hear me clearly? Say hi to everybody. What's up, what's up? Okay, some familiar faces. X Factor has a question right away. We'll get into that. What's up, what's up? What's up, Banks? Cool, sound is good. How's the background sound? It's not overwhelming, right? It's kind of exactly what it should be in the background, sort of ambient noise. Just give me some feedback and we'll get it going. Got my iced coffee. How's the background noise? Background noise good? Okay, so, all right, good stuff. So what's going on, everybody? My name is Ryan, also known as Cantor and Clark on Twitter. Still probably have a pretty decent echo in here. I've made some changes. So, I said the last stream that what I actually want to start doing is vlogging a little bit. So, sort of documenting my day as I wake up, arrive to the computer, go through my sort of pre-market analysis. It's not like there's really any pre-market in crypto. I do have the benefit of obviously being in the New York session, so that's always nice. But I need to make some improvements in here. I'm still waiting on a painting that is going to cover pretty much that entire back wall, and it should be pretty big. And I think that would dampen the sound and reduce the echo a little bit. But as you can see, I don't really have anything on that wall, and the office it's not empty, but there's nothing to dampen the sound. It's just I listened to the last stream and I was like, damn, I can hear an echo even though you guys don't complain about it. So maybe I get those like sound dampening boards. I have two big paintings behind the computer, another painting going back there. So I think that things on the wall should dampen the sound. Yeah, I would love a Fidenza. God, missed out on so many NFTs that I don't know. It's hard to keep your finger on the pulse with everything. And these are things like the Fidenza. The rocks are like really left side of the the bell curve. But the Fidenzas, I think, are I don't know. I really like them. I like abstract art. I like I'm not like a realism fan. What kind of art do I like? I'm trying to think of I love. Let's see. I would love myself a Basquiat. So I think that's considered abstract. Is that abstract expressionism? I don't know what the Fidenza falls under, but it would be in the MoMA, right? It would be in the Museum of Modern Art, if anything, and it probably will be at some point, or some of them. But yeah, going to be streaming hopefully more frequently, getting most of the stuff done around the new house. But anyway. Welcome to the Blockroots YouTube. We try to be a non-sensational source of crypto market and trading analysis, or crypto market analysis and trading. Myself and my partner Josh Rager, we are the co-founders of this. We have a website dedicated to teaching market profile and order flow. So the way that I trade, that's at www.blockroots.com. Just as a heads up, before we get into anything, none of this is to be taken as financial advice. This is strictly for entertainment purposes only. We're just going over, how I look at the market, how I trade, and that's that. And, I try to answer as many questions as possible, but a lot of you, could a lot of people could be suited by just opening a Google browser and opening a Google tab in one of their browsers. So, all right, I think that pretty much covers it. Oh, of course, shout out to our sponsors, Phemex. Not only our sponsors, our partners. So, you know, we don't just share a ref link. They are our partners. We've been partners with them now for going on 2 years. With all of the stuff that's going on across the market, there are only a handful of exchanges that still don't require KYC. Now this applies to people obviously outside the United States, but there is this move across exchanges now to increase KYC measures, KYC AML obviously, but there is a preference by a lot of crypto traders to not have their information or their data be on the exchange, right? Sort of have access to it by, you know, a email address, and that's that, and be pseudo-anonymous, or in that case, I guess, fully anonymous. But Phemex is one of the only exchanges right now that still offers non-KYC. You can KYC on their platform, and you'll get access to, I think, larger withdrawal limits and reduced fees. But right now, it's still, if you use the link below, you'll be able to sign up to their exchange without KYC. They are in the middle of right now trying to get certain regulatory approvals. They offer spot, they offer contract, and they also offer a generous yield program. If you use that link, so the link that we shared, because we are partners, we do get specific bonuses and specific promotional features. You can get access to their 2K sign-up bonus and a reduction in fees. So right now you'll see that there's a 2K sign-up bonus if you are new to the exchange, or if you're a current member of the exchange and you deposit 2 BTC, they're gonna give you 2K. And then from there down at tiers. So if you deposit 1 BTC, you get a certain amount. If you deposit half a BTC, you get a certain amount. So if you're interested in that, and if you're interested in the exchange, it's the fastest crypto exchange. You know, that right now I think is very important. You know, as the market progresses, as the market matures, you want to have access to the fastest tools and the fastest execution. So that's always helpful. So I think that covers it as far as the intro formalities go. Let's take a look at BTC. Let's take a look at some of the charts and wrap it up. Hopefully in around an hour, because again, I have places to be and things to build. Today, another big thing arrived that I need to build. It's a part of an outdoor set that's going to go on our deck. So that's always fun when it comes unassembled, which is pretty much everything these days. All right. Let's see, not that. Yep, that's that. We should move this over. All right, let me just go through, see if I miss anything. Is there any questions right away? All right. Just to touch on some of these fast, because otherwise I'll say I'll get to them, but I'll forget. All right, where is that? There was a question about stops. X factor is 2-3 times the ATR on a 30-minute rotation, good for stops. You know, there's a lot of different ways to play stops. When you're coming up in trading, when you're a newer trader starting out, and this is great advice for anybody. You should have an invalidation for your trade. You'll hear a lot of different opinions as to what that invalidation should be on. Obviously, it should be on your thesis being incorrect. But, for trending markets, certain conditions, obviously you want to take in market conditions as a measure to inform your stops, right? So if you have a market that's been respecting a 20 period, if you find a trend that's, let's say, been respecting the 20 period moving average, found support on it dynamically over time, that's a probably good metric or barometer to gauge the trend by. So if you lose the 20 period moving average, you might stop yourself out of position or have a trailing stop along that. Certain people use structural stops. Structural stops are, they're prime areas to hunt, right? Because sort of the most obvious levels on the chart are areas where you'll likely find stops. So for example, this low down here, while I initially did take a scalp off of the bounce at the lows of this range, I think that ultimately it's not likely a trade to hold, or would be a trade to maybe scale further in a position larger down at these lows, because you have lows that have not been revisited, and this is such an obvious area for stops, right? Structural stops, they're probably the most common stop, just placing stop outside of this low. That's why you'll hear traders be more confident about taking a long if you have something like this, where you took out a low and then, price has found support back above that low. Or one of the better situations would be, let's say you take out that low, okay, the first low is taken out as well after that, and then you have some type of structure build afterward. And it's just the idea that, you've cleaned up an area where a stop hunt would normally occur. And the thing is, that's common, right? The most obvious levels on the chart are areas that your eyes are going to go to and you're likely to put stops on it. And because of that, they're areas that are likely to be hunted. So one of the ways to sort of mitigate for that and improve upon that is to include some measure of volatility into that level, right? The idea being, if, for example, we're looking at a 30-minute chart, we'll pull up the ATR panel. Should pop up in a second. Where is it? It's not here right now. There's this tool that it's on TradingView. It'll show you the ATR for the daily, the weekly. But the ATR for the 30-minute candle right now it's like $240, right? Just looking at profile, just looking at average sub-period rotation. So the idea would be, placing your stop a multiple of that, or just that amount outside of that level, right? So, looking at this chart right here, these lows, all right, rather than just place your stop right outside of that low, what do you do to maybe make it less arbitrary? You place it one 30-minute rotation outside of that. So, in this case, it would be, your stop would be, just get the distance tool. I think it's already on my speed tools. Would be right there, right around there, right? Now, that's 50 basis point stop. It's like 250 actually, so let's get it precise. It's like a 50 basis point stop, which is a good stop, right? If you think about how that fits into your just easy mental framework, or just easy math. If you're thinking stop distance of common references, stop distance of 1%, et cetera, et cetera. So this takes some measure of volatility into account. Now, some people will use a multiple of this, 1.5, 1.2, 2 times. But the thing is, you're sort of getting outside of what a sweep might normally entail, right? Which is a sweep outside of that level. And then, if you're looking for a reversal or expecting it, the idea, if it's in excess of that, would be, hey, this is abnormal, right? If you're 2 times that multiple, if you're back within this gap, clearly you're wrong. But if you're placing your stop, the further you are placing your stop, right, the more you're allowing price to move against you if you're not position sizing properly around that stop distance. So, and I feel like it's important to cover that, because a lot of traders they don't position size appropriately. So if you're increasing your stop distance, you should be sizing according to that. Otherwise, the trade is less attractive, right? If you're using, for example, if you're saying, I want to make sure I'm not stopped out, maybe I'll use 3 times the multiple of ATR. Well, then, you're a considerable distance away at that point. Hopefully you're stopping, you're sizing the trade according to your, personal risk management parameters. So that's one popular way of doing it, is using ATR. But it's obviously, it's one of many different ways. Okay. Trading resources. I mean, there's a ton of resources that I share publicly on Twitter. There's plenty of books that I could give you, but you only learn through experience and just spending time practicing and observing the market. All right. No, I don't think it's best to always use manual stop. I think, I manually stop myself out of scalps a lot of the times, but I wouldn't say that manual stop orders are the best way to start going about things, because, you're allowing for too much discretion, and at that point you're probably going to be letting price move against you. It's a common thing that newer traders do, or just inexperienced or poor traders do. That, I don't mean poor like monetarily, although if you're poor in trading discipline, you're going to be poor, is letting trades just continue to go against them rather than having hard stops. For stop orders, I always use a market stop if I'm placing a stop, so that I'm absolutely out of the trade, even, regardless of slippage. And that's another thing you have to consider, when you're defining a position. Theoretically the position might be such and such in your head. For example, let's say that I place my stop outside of this low by that amount, 50 basis points, it's somewhere down here. My stop is, let's say, 47,895. If price falls between that level, starts aggressively moving lower without finding any kind of immediate response outside of this low, meaning if we break below that low, it doesn't yet reverse, and it starts coming towards my stop, and I let myself get stopped out. It gets stopped out. I'm not around. I get stopped out. However it happens. Chances are, price moving through that level using a market stop, you're going to incur some slippage. So what you define as your trade risk in your head, or before the trade occurs, sort of textbook wise, in a perfect situation, is not actually what you lose. You lose more because you have to account for slippage. If you don't use a market stop, or if you don't use a market stop, you run the risk that your trade will not be executed, filled, right? All right, so let's take a look at the market real quick. Today, S&P up, decent open, MicroStrategy down, oddly enough. You have now an asset that is no longer really correlated to traditional market benchmarks or indexes or indices, but is now correlated to BTC, and BTC is down today. So just something I was noting. But BTC down today, traditional markets up, tech pretty flat. So nothing really, I guess, on that front. We've seen that the correlation really picks up when we see extreme moves to the downside with the S&P, and a lot of times I'll quote the E-mini. I'll look at the ES. So for those of you that are unfamiliar, when I don't have the S&P chart up and I'm looking at something labeled ES. But right now we're just seeing pretty much a steady rise, new all-time highs kind of thing, handicap ramp, equity index. So, and the ES is the equity index futures. So it's an E-mini, right? Don't want to drown on too much. I think you guys know what that is. But nothing that is cause for concern with equities, right? So nothing from traditional markets that we really have to worry about. And it's not something I'm familiar with this when I look at the computer in the morning, but I figure, we're doing a live stream right now. It's important to just sort of go over a brief look that I would normally do. Looking at BTC though, right? Let's go to the Coinbase chart. That's basis, so you can see that red is perps. So right now, perps are buying the dip. Okay, never a good thing. Where is the chart that I wanted to look at? Here we go. So 50K was our most significant level. All right, 50K, to me is the most significant level. The weekly and daily level is right there though. So you're looking at prior weekly lows for this range going back to April. And you're looking at a daily level as well. That's April, right around April 25th, April 26th. So for those of you that can't see the dates or don't have a chart handy, that swing low, right? Prior range lows, I'd say that's the most important contextual level. This general area, right? Losing my voice. 50K, that daily, weekly level. This is the most significant resistance on the chart. This is where you would want to have seen fireworks, and it's kind of where we're rolling off of right now. So I think if you are looking at this on the high time frame, you can see that the risk reward really isn't there for any kind of new longs. Excuse me one sec, guys. I need something to drink because my throat is like something stuck in my throat, and coffee just, I think, dried it out or something. I don't know. Hold on one sec. I'll be right back. And we're back. Okay, sorry about that. Sitting in the back of my head, thinking about how I couldn't clear my throat. Wasn't gonna shut around like that. Okay, so most significant level, or one of the most significant levels on the chart that we could possibly interact with. That's where we're sitting. Right now, I think that, again, in terms of risk reward, it's clear that this doesn't really favor longs, at least from this point on the chart. The most significant next level to define some type of long position in terms of contextual risk reward is back down at this August 18th swing low. So we're looking at right here. Had two interactions with that level that were significant so far. So two turns basically on the daily. But if you look at this on the weekly chart right now, there's really no structure underneath us. As far as swing low goes, as far as any kind of pullback on the weekly, it's just been a one-way trip for the last month and a week, so 5 weeks. Right now, as I said in the stream the other day, we were opening up this weekly without a wick, clearly having some action now to the downside. You notice a few things at a significant level like this, or you try to look for a few things. We didn't have any kind of extreme version of this, but we started to see, again, I said this in the last stream, we started to see some signs of overheating. Nothing really significant though. So if you look at, for example, like funding, I have something to admit. I was just eating peanut M&Ms too. When I walked to the kitchen, I got some peanut M&Ms. My wife, my wife left them out. Probably not the best thing to have in the morning. But funding right now is, neutral. It was negative to neutral most of the way up. Not negative, but across a couple exchanges, it was, more neutral than anything. The point is we didn't have any kind of major overheating. But the last sort of, I want to say now it's like 3-4 days. It was more extreme 3 or 4 days ago than it is, the last two. We started to see futures really getting a bit more aggressive towards the highs. So, best example is like Bybit trading at around, paging Dr. Freud. No, this is a weird conversation. Never mind. My wife and I were talking about, there's a home that's for sale right next to our house, and that we're like meeting all our neighbors. God, I'm gonna go into a whole nother tangent now. You guys know I love tangents. We're meeting all our neighbors. We love all our neighbors. I got the PGA Pro to my right, but the people to our left, they're two sisters. They inherited the house. They're moving in 2 months or 3 months, and my parents are trying to buy a new house. So my wife was trying to get me to convince my mom to buy the house next door. I couldn't believe the fact that my wife was saying that she wanted her in-laws to live next door, but whatever. So these conversations are still in my head. Anyway, it's okay. So we didn't really see any overheating throughout this entire move up, but we started to see it more recently, and overheating again in the form of like Bybit, for example, getting very aggressive. You'd see, this was like 4 days ago, Bybit was trading at about $100 premium for the first time to Coinbase. We didn't really see that the entire way up. Majority has been a spot-led market. So one thing we said was, the first sign of it isn't where we start just immediately flipping, because this can persist. But, this is a very significant level that even spot traders arguably could look to sell, or at least start to manage the trade, or start to monitor the trade more. At least start thinking about it, right? One thing I said a week ago was, if you're a larger entity, pension fund, asset manager, maybe not hedge fund because they're more fast money and they're likely to be nimble and get in and out of positions. But if you're someone who is, a corporate structure, picking up BTC, making a long-term bet, odds are you're not, buying it here to sell here. So these things are just fun, I guess, thought experiments to go through. Like, the people that are buying now, why would they want to sell here? Hold. But at the end of the day, this is a market that's traded a lot on technicals, and this level was so significant previously, it makes sense to see some form of kickback here. The question is, what kind of recourse is going to come from the rebound off of this level? Are we going to see a deeper pullback? I don't know, honestly. I have no idea. I just know it's not the best area to open up fresh longs. If you're, looking to add spot, I think that honestly, I would be at the point where we are now, after having some type of pullback, I would be happier to see a strong move up where I'm buying at 51, 52 than, after moving sideways here, than just to buy right here. Because, from a risk reward standpoint, if you're just defining a short, right? If you're defining a hedge, your invalidation is up here, right? And your next significant level is back down here. So just in terms of risk reward, which side is larger than the other. So next level on the daily, around 44.7, 45, kind of large round number again. Key psychological number, I would say, below us. You see the round numbers are where a ton of the volume comes in. It's not a ton, rather, it's just where, if you were to look at like a tick chart of volume across a range of prices, you will see that on round numbers, very obvious ones especially, increments of 5K now, I would say, work. You'll see more participation at those levels. More trades, more volume, etc. On the weekly, not that I think we're coming back down here, based on what I see right now. Obviously, it doesn't mean we can't. This is your next weekly zone down around 39.40. Again, I think that would be a great buy the dip zone if it came. Same for 45. I think the same of that. Just because this entire move up has been, it has been spot driven. So I don't think that the market is in that dangerous of a position, being that it doesn't seem like there's a lot of leverage in the system. So that's always something to consider. Right now, if we just look at, for example, just look at profile, we re-accepted back within what was a original area where we had a break from balance set up. So re-accepted back within this range. And re-accepting back within the range, you're expecting price to sort of fall into the same behavior it did prior, which is treat this range with respect. Okay, so range lows, this was originally why I got into a scalp down here and closed it before the stream. Range lows in play, right? I would rather see, if I was looking for a move back up to this high, I would rather see that these lows are probed a bit more. But on the same token, it could be said that because things have been bullish and there hasn't been major overheating, that levels would be front run, right? We're all kind of expecting the stop run, wait for the stop run, et cetera, but saying a lot of et ceteras in this video. That must be me being lazy. Whoops. But instead, the level gets front run. I would personally feel more comfortable, if I'm looking for, let's say we're looking at this range right here. This is, pretty, not a gap down, one-sided move down, not much established within that move, right? Not much two-way trade, I guess I would say. I would rather see, price take these lows and then look for something back to the underside of this structure and potentially back to these, this, 49.5 level. And if we just put on where our previous day levels were, we'll see that that 49.5 level is right around at the daily open. This kind of pattern though has occurred previously, where we've had, you know, a period of, like I've said throughout this entire trend, you've had double distribution type trend day followed by maybe 2 days max of balance before continuation. The only other time, and one time in particular looked very similar to this, where you had extension like this followed by trading back below where most of the volume came in. So you have a range, right? Range expansion. Okay, volume is established higher, but price can no longer maintain that base. The only other time when we've done this, where you've accumulated this type of volume at the high and auctioned back within the prior range that led to that expansion, we've had a more significant pullback. And that's just to not like take for granted that you guys are familiar with what I'm talking about. We'll just pull that up. Let me just turn the sessions off. Actually, sessions will probably indicate it a little bit better. But there's going to be a lot of sessions now. Okay. So we're looking at, this is a good example.